Welcome back. Bidvest says it's delivered a solid annual performance despite volume contractions in renewables and the new vehicle space. The group's posted a near 7% rise in headline earnings as 5 of its 7 divisions reported profit growth. Its CEO Mpumi Madisa joins us now. Mpumi, thanks so much for your time today. Now, right at the top, the last time I spoke to you was around March, and we spoke about how difficult it is to operate in this current economic environment. Bidvest has, though, managed to deliver that near 7% growth in earnings. Would you say this is due to the fact that, Bidvest continues to just gain more market share in the industries it currently operates in?
Good afternoon, and thank you very much for the opportunity. So I think it's a combination. I certainly think that whilst organic growth was strong, it was softer than the 2023 financial year. And acquisitions also contributed in a big way to our numbers. So if you look at both our top line and our bottom line growth, you'll see that the 11 acquisitions that we did in South Africa and in our offshore operations did contribute. Locally, from an organic perspective, we are still seeing market share gains, though not across the board. And you've already touched on the volume reductions in new vehicle sales and on the renewable side. So those are the two negatives in the numbers. But on the upside, travel volumes were still strong. In the security cluster, we had really strong new wins. We saw nice price increases come through. And then from a trading perspective, outside of renewables, we also saw a nice increase going through, whether we're selling from a B2B perspective in our commercial products division or through the retailers in our branded products division. So I'd probably say it's more of almost a 50-50 mixed bag between organic and inorganic growth.
Let's zoom in on those two divisions that didn't perform well, the renewables and vehicles business. Take us through some of the pressure points there.
Sure. So from a renewables perspective, and just to give you some numbers, our renewable sales in the current financial year were just under $1 billion, and that compares to about $2.5 billion in the prior year. So really, we've just got a very high base. And the reduction in renewable sales is really just a function of reduced load shedding. We haven't had load shedding in months. The consumer doesn't have the pressure and the need to be buying renewable products. And so we are seeing a significant decline there. If you actually exclude the impact of renewables on the commercial products numbers, the rest of the division is actually up at a trading profit line, high double digits. So the balance of that business is done well. And then if we go to automotive, new vehicle sales contracted quite significantly. We saw a 7.8% contraction in volumes versus a market that was down 6.2%. That was exacerbated by a contraction in margins as well. And we are overweight traditional OEMs. And what you also saw in the year under review is your newer OEMs, your kind of Indian and Chinese brands, increasing market share. And that's really where the main pressure points were in the automotive division.
That just brings me to my next question. I wanted to get a sense or some commentary around what kind of trends you are seeing in that automotive space, considering that, new vehicle sales have really been down, but we have been seeing some sort of recovery perhaps within the used vehicle sales. So what kind of trends are you seeing between new vehicle sales and used vehicle sales?
Yeah, so before I go into the detail of the two, I think overarching is the fact that the consumer is under pressure, under significant pressure. From an environmental perspective, interest rates are high. They're coming down, but they're not coming down at the rate that we expected they would. Inflation has been high, it's coming down, but inflation is still high. So the disposable income purse is really under pressure. And generally what happens in South Africa is that consumers then buy down, okay? So they would either buy down by brand and stay in the same brand, but go to a cheaper model of car, or they will switch brands. They'll come out of a brand that they can't afford into a brand that perhaps still gives them a same class of car, but it's cheaper. And then the third piece is that they'll then buy down into used. So the reason why you would see increased activity in the used side is because people are choosing to not buy new cars, and to rather buy used vehicles, and that's basically what's happening in the mix. And so, I mean, I've hinted and touched already on the newer OEMs that are coming in. They are coming in with cars that are more affordable. They are competing quite head on with the traditional OEMs, and they are taking market share. We have seen over the last 2 to 3 years their market share increase year on year.
Now let's get back into those numbers. Gross margin slipped a bit from 29% to 28.4%. Was this a case of the current macroeconomic environment?
Yes, it is. It's a function of the macros. It's a function of high inflation. It's a function of high distribution costs. And that is really the main area. I must though say that gross margin management in general was really good. And the main areas where the impact around the decline in the gross margin comes through is in the automotive space and maybe in 1 or 2 other businesses. But overall, the gross margin management was really good. But it is really just a function of the macros.
You touched on acquisitions earlier in the conversation. Just take us through some of the businesses that boosted growth on the top and the bottom line there from the new businesses.
Sure. So in the period under review, we conducted 11 acquisitions across South Africa, UK, Ireland, Australia, and Singapore. And if I start offshore on the bigger ones, we doubled our footprint in Australia in facilities management with the acquisition of Consolidated. We made our first entry into Asia. We acquired rental hygiene services in Singapore. Those are the 2 big ones. And then in the UK and Ireland, we made bolt-on acquisitions that give us an increase in our basket of offering, both in our operations in Ireland and in our operations in the UK. And then from a South Africa perspective, we also had a couple of bolt-on acquisitions in the data print and packaging space. We made some acquisitions there. In Services South Africa, we acquired Interlock Freight Services that bolstered our Bidvest cargo offering. And then we still have a little bit still in the pipeline. So more acquisitions have come through the first quarter of the new financial year. And we do have one larger transaction called Citron that operates across the US, Canada, and UK. And we are waiting competition authority approval in the UK on that one.
Now, while you are picking up some assets, you are dumping some assets, particularly in that financial services unit where we are seeing the sale of a Bidvest bank being announced a few months ago. Just take us through the rationale behind that move and whether there's been some suitors coming to the table.
So I'd like to use the word we're positioning assets for future growth rather than dumping. And I make that statement quite firmly because we went through a process of reviewing our portfolio. We went through a process of assessing capital allocation for the future, what we think fits and what doesn't. And the reality is that the financial services industry is highly competitive. It is digitally driven. There's been a consolidation in the market over the last 3 years. We are one of two-tier banks that are left. The rest have all been acquired by the first-tier banks. So there's a real structural shift that's taken place. And our firm belief is that the bank would be better placed for future growth and for their aspirations to be achieved if they are in financial services hands. So we really see this as positioning the bank for its next phase of growth. And we don't believe that's necessarily with us. So you're correct. We made the announcement on the 3rd of July. We will be, and in fact, we have started a sale process for Bidvest Bank, Hoffman Global, and we're also including Bidvest Life in that process. There've been a number of interested parties, a significant number actually, interested in Bidvest Bank. We've gone through a process of looking through and screening some of those applications. We're sitting with parties in the mid-teens that we believe have got the capital, unencumbered capital, to make the acquisition. And all of them are in financial services already. And we're now really just going through a process of reviewing those applications, having conversations with the regulator, and getting ready for the next phase of the acquisition process. What we have announced is that we plan to come to market with who the preferred bidder or the preferred acquirer will be latest by December this year. We will still have the process to complete because there's still regulatory approvals, etc. Post that will be required. But we hope to give market certainty latest by December this year.
We'll definitely be keeping an eye out for that deal once it is sealed. Mpumi, thanks so much for joining us today. That was the CEO of Bidvest, Mpumi Madisa.